Let's take our conversation forward. Ravi Dharamshi joins us to chat. Let's connect with him to understand what his ideas for 2022 are, how is he differentiating in terms of a portfolio strategy, and how worried is he about what's happening to inflation, both local inflation, global inflation. Ravi, good morning. Thank you for joining us. You're dressed differently, Ravi. So looks like you are in a different, I'm seeing you for the first time in a different avatar.
First of all, thank you. Good morning. Happy Lori and happy Makar Sankranti to you and your viewers. And I hope everybody is safe and protected from the new Omicron wave that is coming about. But yeah, I am in somewhere in the interiors of Maharashtra and it's pretty cold out here.
But is it time to dress your portfolio differently for 2022? Do you think, given that inflation is coming back, the base effect for a lot of companies would kick in? Is it time to dress your portfolio differently is it time to dress your portfolio differently?
No, for sure. There is some changes that we are doing in the portfolio, and we are very reluctant to usually change our portfolio. So, but it is markets don't move calendar year to calendar year, so we like to do it when we see the tea leaves changing. So, I think one sector, even last we spoke, specialty chemicals is one sector that we have been invested for the last 6-7 years, and that is where we are constantly reducing our weightage. I think the sector has done fantastically well, and there are some margin headwinds and some near-term issues, but for the longer term, I still believe the sector will continue to do well. But I think it is pretty much priced in. So that is one space from where we are reducing, and another space is we are increasing our weightage in companies where there is a little bit of play on the cyclical recovery, whether it is real estate cyclical recovery or whether it is auto cyclical recovery, and we are playing some of that through financials as well.
Historically, you've managed a portfolio which has been pharma and tech heavy. So let's talk about pharma. It's been a year, or 2021 has been a year of both good and bad for pharma. It started with a lot of promise, but then pharma became the eyesore and the drag. Why is that happening, and can pharma stocks make a comeback this year?
So the reason why pharma is underperforming is very simple. One is that there has been a consolidation amongst buyers in US, which has led to a structural downtick in the pricing of the oral solid generics in US, and that has become a large part of the legacy portfolio for a lot of pharma companies in India. The second part, which is the exciting part, whether it is biosimilars, inhalers, antiviral, COVID portfolio, all those things are leading to growth, but market at this juncture is looking at it as a one-time opportunity and not giving it any kind of a valuation. So the valuation, I believe, over the last 5-7 years have become very, very reasonable, and we are waiting for some triggers. Physical inspections of the plants have started, and we are witnessing. This will have some negative impact, but there will be largely a positive impact as the drug approvals also start coming through. So I believe this is a good risk-reward ratio to increase some weightage in pharma at this point of time. We had reduced our weightage a year or so back, and we will be looking to increase some weightage again.
Ravi, when you say you're bullish on financials, I'm trying to understand which end of financials, because technically even Paytm is a financial, PB Infotech is also an financial. What end of the financials are you bullish on?
No, I'm not talking about the fintech space or the aggregator space, online aggregator space. So I am more bullish on the traditional lending business, and for once I can say pretty much across the board. But our bets have been placed more on the larger private banks. We are backing some cyclical recovery in auto, so CV cycle is on the verge of revival. So maybe CV finances, vehicle finances, and the third is the revival in real estate cycle. So we are betting on some housing finance companies as well. So that is largely where we are looking to increase our weightage. We have increased our weightage as well. So it is largely a play on the cyclical recovery. in the economy, and these are the ways in which we are playing it.
Good morning, Ravi. I want to juxtapose what you have just said about cyclical recovery with what you said about a month ago, and that you said that the new winners of the Indian stock markets will be those that will bet on India's new internet, new age businesses. Now, since then, a lot has changed, whether it is the US Fed, markets understanding the value of money, the era of easy money ending, people looking for profits. And back home, we've seen what's happened with internet companies, as has happened on the NASDAQ. So how should we look at that? And now what you're saying about cyclicals?
No, so it's not mutually exclusive. I'm bullish on both the spaces. We have exposure to the internet technology platforms as well. See, Nantara, for sure, there is a big boom happening in the startup world in India. And the startup world is now almost 1/10 of the listed space. So it's not a small space that can be ignored. And a lot of these companies are going to get listed over the next couple of years. So till now, the big boom that has played out in US was because all these technology companies were listed, and rest of the world has underperformed US broadly because we never had these new age technology companies. But now we can say with a lot of certainty that this ecosystem is stabilizing. The winners or the sector leaders are getting identified. Unit economics are getting stronger. Some of these business models are crossing over the hump of the critical mass is coming through. So these business models, even though they are not profit making at this point of time, but are the future of this new boom that is happening. So one cannot ignore this space. One has to be constantly looking at it, and you can place your bets selectively. But this is where majority of the wealth creation is going to happen over the next 5-7 years.
Okay, so that's where it'll happen over the next 5 to 7 years as far as wealth generation goes. Picking up on what you said is about real estate and the new trend, and of course, when a real estate recovery happens, it's not weekly or monthly; it's multi-year. How should one approach it? Should it be directly with the builder stocks, the real estate company stocks, or it can also be maybe indirectly, whether it's paint companies, wiring companies?
So I think, again, I am not very picky and choosy. We actually started playing first with the building material companies. Then we bought into developers as well as the housing finance companies, as I just said. So let me just give you a sense. I believe the drivers are the strongest in the real estate side. The supply consolidation that has happened is by far one of the biggest across all sectors. Nearly a 50-60% supply vanished and is not going to come about very soon. And the real estate recovery is not driven by pricing; it is driven by volumes. So what started off as some small benefits being given by the state governments regarding stamp duty or such things, which led to the marginal housing consumer jumping in to buy a house, has sustained even after those incentives going away. So that tells you there's a lot more leg to the real estate recovery. One of the lead indicator that we usually look at is the IT sector wages, because finally that is where most of the migrant labor is. Now, IT sector as well as the startup world combined has created a lot of wealth for individuals, employees, mid-level management, promoters, and these guys are looking for better places, better houses, and they are going to spend a lot of money on that. So that lead indicator is pointing us. This is one of the few years in which Infi, TCS, and so many companies have taken more than one wage hikes. And the level of attrition and the demand for talent is telling you that this tightness is likely to remain for some more time. So and that is something that plays into the real estate cycle revival. So, and these cycles usually are very, very prolonged. They don't turn on a head. So they will last 5, 7, 10 years at least. The downturn also lasts that long, but we have just begun the upward cycle. So I think you should play as and when across the value chain, no problem at all.
Ravi, hi, morning. You've often also, very strongly created on the decarbonization theme. Now, one way of looking at that is via the ethanol play, and I'm going to come to EVs as well in just a bit. Do you believe that, sugar companies, infra companies like Praj, etc., are in a multi-year bull run, so to speak?
No, clearly, India has started off on a path towards decarbonization. We have set ourselves stiff targets by 2030, as well as the larger aspirational target of 2070. So ethanol is only step one in that direction. In that to first generation ethanol. So ethanol from sugar, molasses is going to, very incrementally add to that. The next steps will be second generation ethanol. The next steps will be giving a lot of push to the other renewables. And but this trend is here to last. And this trend is worldwide. So the beauty about the ethanol story is that there are very few players on the shovel side, on the equipment manufacturer side. So it's a very, very solid industry structure, and there's a huge opportunity compared to the size of these companies. And this is a very time-bound opportunity. It is going to pan out over the next 3, 4, 5 years. So these companies can end up being multifold in size from here in next few years. So I am very, very excited about this particular set of opportunity. And also for the ethanol producers, it is less than a 2-year payback. So this kind of profit boom, and what it does is for the sugar companies is it takes away some of the cyclicality that sugar as a commodity brings into the business. This is a more year-round kind of a commodity, the ethanol that I'm talking about. So that adds a lot of credibility to the numbers, and there is a possibility that sugar companies might not be valued anymore like a commodity company, and they might actually become sugar plus ethanol plus power play. So that can improve their valuation multiples. So yeah, decarbonization is a multi-year long theme, and within that, if you can find a good bet, stick around. The trend is not changing anytime soon.
Yeah, indeed. It's somewhat like IT or tech for that matter. It's so fast evolving, the technology here, and how this space is going to grow. I wanted to also talk about the other segments besides ethanol. There's EVs, there's renewables, there's the hydrogen play as well. Within the listed space in India, how do you get a piece of that pie?
That is our complaint as well. There are not too many plays, but I believe this space will expand. Existing listed companies will announce plan to foray into this sector. New companies will come to the market, will get listed in this space, and the overall this space is going to expand. And yes, but that is a challenge at this point of time. We don't have too many EV plays. In fact, there are legacy players who could actually bear the brunt of some of this disruption that is happening, which we are witnessing. So, for example, in two-wheelers, the valuations are very, very attractive. But whether these companies are valued traps or whether they go on to become fantastic winners from here, only time will tell, because I am not in a clear position yet to identify whether to bet on the old champions or whether to bet on the new oats.
Ravi, ethanol is one profit pool. What are the other new profit pools which you are excited about? Like they say on Dalal Street, where is that space where profit ka dhamal hone wala hai?
So one space where I feel that a multi-year long theme is unfolding, and where there are multiple tailwinds that are emerging is manufacturing. And I am going to resist using the word capex and say manufacturing instead. See, the capex cycle of 2003 to 8 was very different from the current capex cycle that is going to start. The capex cycle in 2003 to 8 was driven by thermal capex, telecom capex, as in thermal power plants, telecom capex, steel, and real estate. Out of that, I don't see thermal power as a capex driver anymore in today's day and age. Neither is telecom going to have the same kind of an impact. Probably 5G is going to happen couple of years down the line, but not at this juncture. So this is a very different cycle. It is being driven by the supply chain, global supply chain shift happening towards India. It is being driven by PLI schemes. Are you able to hear me? Are you able to hear me?
Let's take it forward. Yes, loud and clear, crystal clear. Even though you're joining us from Maharashtra interiors, we can hear you.
sorry. No, so what I was saying is it is being driven by the Indian government is taking a three-pronged approach. They are providing incentives, they are providing protection from dumping from foreign countries, and they are changing the sourcing norms for localization. And this is leading to increase in competitiveness. And this is not only, but there is an exports opportunity also opening up. So this particular capex cycle is actually going to be driven by manufacturing. And in manufacturing, there are many companies available which are in the turnover range of 500 crores to 5,000 crores, and which can potentially become very large over the next few years. So that it is a very fertile area to look for companies that can scale over the next few years.
No, Ravi, we've discussed your basic approach towards pharma, but I just want to go back to pharma because you understand that sector thread and bare. Which end of the pharma again you're excited about? Because let's say a year and a half ago, the landscape was different, the underlying commodity trends were different, the API pricing was different, there was a COVID fillip which came in the balance sheet of some of the companies. Now as we talk about FY23 and beyond, what kind of positioning in pharma are you doing? Are you going back to your good old favorites, or are you approaching pharma but different names?
No, so I think instead of trying to focus top down on which pockets, I would like to see companies that have shown agility, flexibility to adapt to the changing scenario. So opportunities have come about suddenly in the space of COVID or retrovirals, and companies that have shown ability to capitalize on these opportunities that come about as one time and then last longer than expected. These are the companies that will move from wave to wave, trend to trend, and you are better off placing your bets on that. Second way to look at it is obviously where are the profit pools? The profit pool is in the biosimilars, the inhalers, the complex generics, specialty generics. Those are the places where the profit pools are still protected to some extent as compared to the oral solid generics. And which are the companies that are positioning to address those particular profit pools over the next 3-5 years are the ones that are likely to show a substantial growth in their profits as well as in the return ratios. So focus on that. And of course, you have to clear the basic hygiene factors of meeting the minimum manufacturing practices of US FDA. US will still remain the large market. So for all practical purpose, US is the largest potential profit pool for the Indian generic players.
Ravi, hospitals are making a comeback. COVID, no COVID, business is stable for them. Medical tourism hopefully will open up for them. Diagnostic is a space where you've invested in the past. Pharma companies or pharma online companies are planning to go public. That is going to be a large sector. Anything else which qualifies, which is outside the traditional pharma or a manufacturing pharma space?
So definitely we continue to like the diagnostic space. Unfortunately, the stocks have been overpriced since a while now. So we are not yet able to figure out how much of this COVID related demand is one time and how much will sustain. And we need to see beneath the surface and to see whether the longer term trend is the market factoring in a longer 15% kind of a growth, or are they pricing in a 20% kind of growth? I believe from a longer term perspective, having on this large base 20% growth is going to be a challenge. If you are able to find a company that is not factoring in more than 15% growth, then in diagnostic space, that is where I would be willing to look at. Regarding the pharma tech, that new business models that are going to come up, especially about delivery, pharma retail, they are good business models. They are still in a phase where they are burning cash. Soon enough, they will come to the market, and the market has consolidated with 3 large players, Tata, Reliance, and forget the third one. But so the three large players have, so to say, consolidated over here, and the structure is more or less stabilized. So it is in that way, that sense, similar to the food delivery. I think over the next few years, more consolidation, cost optimization, and going towards the profitability phase is what will ensue, and that should give rise to a lot of winners from this space as well. I like this space. We don't have a bet as of now.
Okay, we'll leave it at that, Ravi, and thank you so much for taking the time out, for joining us from the interiors of Maharashtra, and for being so candid for what your strategy is going to be, at least for the medium term. It's always a pleasure talking to you. Thanks so much.
Thank you so much.